Assalamu Alaikum everyone, welcome back to the channel. Ramadan Kareem to all of you. In today's video, I'm going to share with you some of the things that I look for when I start in a new position. So every time I'm starting a new position, some of the things that I do, first of all, is obviously check if the company is Sharia compliant. I've used a couple of apps, and I also check the fundamentals as well. So in today's video, I'm going to talk about some of the things I look for when I'm starting a new position. So when I first started investing, one of the things I did, and one of the things I actually recommend everyone to do, if you've maybe started last year or year before, and you still, your early journey, really recommend you guys to read some of these books. So this is one of the books that I started with. So William J. O'Neill is actually done a couple of books, of how to make money in the stock markets, and is really good. What I love about this book is basically he takes every single fundamentals that are important to new investors or old investors as well, and he breaks it down and basically gives you an idea of what to look for. So it's a really good book, and this is one of the books that I've started with, and I highly recommend it. I will leave the link in below the description section, so you can have a look at that, and if you're interested, get it. Honestly, I bought one. I've got one right in front of me right now. I've been reading it. It's one of those books you read it once and then you go back and you learn new things, and I literally highlighted my book. If you see it, you think I'm crazy, because the whole summer, basically last year, that's all I've been doing, just basically going through this book, page by page, highlighting the key matrix that I need to look at when I'm starting a new investment. The next book I would definitely recommend is One Up on Wall Street by Peter Lynch. Peter Lynch is basically one of the greatest investors of our time. This guy basically made about 30% or more every single year, beating basically the S&P 500. So he's a great investor. Again, very similar to the other guy. He gives you ideas, and they give you both books, what I love about them is they actually give you great examples of companies that existed and what happened to them. So it's not just like some random person they've done these things before, so they know what they're talking about. The final book I will definitely recommend is this one here, is Intelligent Investor. I'm sure you've come across the Benjamin Graham's book. This one I really love the fact that it kind of keeps you humble, for example, right? So because of this was the lecture, Warren Buffett's lecturer basically, and Warren Buffett loves him. I read this book, it's a quite big one, but I've read page to page. It's really good. If you are starting in basically new investment, it's really the where to start. These two will teach you the basic things to look for, the new matrix, whatever. Well, this one, it will help you basically become an intelligent investor. Someone who is grounded, someone who knows what they're doing, and you are thinking about the long term, and you're not just buying and selling, in and out of companies and so on. So they are really great books. I'll put the links in the description, so if you're interested, have a look at that. So in today's video, the things that I've basically helped me over the last year or so are this. So here are the 10 things that I look for. There are obviously so many metrics to look at, but I just broke them down into this. And it was only over the last 6 months I decided to do this. Beforehand, I was actually all over the place and buying companies, and I wasn't sure what I was doing and so on. I'm still learning. I'm not sure what I'm doing. I'll probably be making mistakes right now as we speak. But alhamdulillah, it's been good so far, and I've done all right. So if you look at my portfolio, maybe it's a luck, maybe it's not. It's about 14%. Whatever the case might be. I'm not saying I know what I'm talking about, but this is some of the things that I look for personally. So I'm gonna break them down, each one of these things, and then we're going to use Intel as an example of where to find some of these things. So I'm going to talk about each one of these things, and I'm going to show you how you can find in basically using Yahoo Finance. Yahoo Finance is my go-to place. It's really great, easy layout. It's kind of boring, but hey, it does the job. That's what you want, isn't it? So one of the first things you should be looking at is basically economic moat. What that means is, what you're looking for is, does the company has basically distinctive advantage, competitive advantage over its rivals? Basically, do they have something other companies cannot offer? That's what you're looking for. Okay, not every single company that you invest in will have that sort of a thing, right? But some of them will do, and if you can find those companies, perfect. Okay, so this is not like, by the way, I'm not saying this is a must. Okay, so every single thing that you see in here is not a must, but you have to obviously value the whole company rather than just focusing on just 10 elements of it. Okay, so the economic moat, I think, is something really important. If the company, for example, pharmaceutical companies, they tend to have, for example, patent for specific drugs they produce, and that is important. Okay, some of it runs out after 20 years. So if you know your company that you own basically, or you own shares of, basically have a 20 years of, for example, coronavirus vaccine, whatever, right, which is not happening at the moment, that is great, because you know the next 20 years and they're making good profit. That company will be generating profit for you for the next 20 years. So that's some of the things that I look for. The next thing is PE ratio. The PE ratio basically is one of those things, and if you read this book, actually he says that it's not really important, and I kind of agree with him, but it's some of the things that I look for still, because it kind of gives you a quick glance whether this, you know, stock is overvalued or not. So what you're looking for is less than 20. Okay, but if you're looking for technology companies, if you are looking for the Microsoft and Apples, whatever, they might still be undervalued and over the, basically their PE ratio might be over 20, because they are growing companies, they are slightly different. Okay, so when you look at the PE ratio, just be careful, because some companies, actually some terrible companies, might have PE ratios less than 20, but that means because they're not actually making profit, they're not actually, their earnings is absolutely terrible. Okay, so again, just be careful. Don't use this to kind of value your, basically whether it's a stock is a, you know, overvalued or undervalued. There are other things that obviously that will help you understand that. Okay, and if you want to basically find out how to value or how to calculate this, okay, all you have to do is basically take divide the current stock price, so current stock price divided by the earnings per share. That will give you the value of the PE, and if it's less than 20, obviously happy days. If it's not, just be careful. There are other things you need to look for as well. Then you've got the growth revenue. This is something that I think is really important. Over the 4 to 5 years of, you know, revenue growth is great. Profit margin, similar, again, 4 to 5 years. So the gross profit and the gross profit margins as well. So these three things we're going to look at in a second. I'll show you a bit more details of these sections in a second. Current assets, current liabilities. So this looks at, okay, for the next basically 12 months, can this company pay off their liabilities by just using their current assets? Okay, so if the current assets is greater than current liabilities, then that's a tick. Free cash flow, last 5 years, 4 to 5 years, if they've been growing their free cash flow, then this is the money they will use obviously to pay dividend, to grow the company by obviously investing in more in the company and so on. Number of shares, you want a company whose shares are declining, so they're not issuing new shares. So the reason for that is because every time they issue more shares, okay, your slice of shares basically becomes all of a sudden worth less, if that kind of makes sense. Okay, so if the company is basically issuing new shares every couple of years, okay, then that means there are more shares of this company out there, so your basically what you bought, your one share that you originally bought, is now worth less basically. Return on equity is important. Again, I'll show you how to find this. The book that, you know, the couple of the books that I've read, basically William J. O'Neill actually talks about a lot about that, and he actually recommends this to be over 15%. Okay, so if you can get 15-20%, then really good, or more than 15% is actually really good. Now, if the company pays dividend, you also want a company and that's paying, you know, spending about their 60% of their revenues, of their profits on basically, or their free cash flow, 61% or less basically. Okay, so the free cash flow the company receives, they should be spending about basically 60% or less basically to give you the dividend. Okay, if it's more than this is okay, up to maybe 70%. 80% is dangerous. They might cut it anytime soon, and if you're investing in that company for that reason, then you really need to be careful, because that dividend could be cut anytime soon. All right, so now what we're going to do is we're going to use Intel, and I'm going to show you how to find each one of these things. Obviously, apart from the economic moat, which is basically you just need to look at the company itself and decide whether they have a moat or not. All right, so let's have a look at Intel. So Intel is obviously a tech company, a semiconductor, one of the biggest companies around. It's been down a lot lately, but it's actually for the last month or so, I think since 2021, it's been going up and up and up. But let's have a look at it. So the moat for this company at the moment, I don't think they have a moat. Okay, so you've got AMD, you've got Taiwan Semiconductors, and other companies that doing similar things. And in fact, they haven't been. They used to have a moat, but not anymore because of like I said, AMD and other companies around. Okay, so the other thing that we need to look at, the second thing we need to look at, is the PE ratio. And as you can see, their PE ratio is about 13.82, which is really, like, I was surprised when I saw this today. Okay, but this doesn't mean this you should go straight away and buy this company, because there are other things that, like we said, that you need to look at. Okay, so the PE is less than 20, so that's a tick. So revenue growth. So when you're on Yahoo Finance, straight away will take you to summary. Just go to financials. Okay, if you go to financials, and the first section is the income statement, and that's the bit that you need. And if you can see here, basically from 2017, okay, this company actually produced about $62 billion in revenue, total revenue. Then you get 70, then 71, then 77. So last 4 years, basically, they have been growing their revenue. So that's great to see. Now the cost of that revenue, so how much have they spent in order to make this? Okay, and you can see 23, 27, 29, and $34 billion. Now, one of the things that I've mentioned was the gross profit. So that's the next one. So gross profit, that's one thing we need to look at. And that's this. Okay, so that's basically the difference. So $39 billion, $43 billion, $42 billion, and then 43. So as you can see, it's growing. So their gross profit is growing because they're spending less than they obviously making, which is great to see. So this is that section. So once you've done that, the next is we look at the profit margin, and we're looking for about 10 to 20%. If you can get more than that, perfect. Less than 20, really be careful, because anything can happen. Maybe the company is not making enough revenue, or maybe something they're spending a lot of money on something else. So you really have to be careful. Okay, so in order to find the profit margin, you need to go to statistics, scroll down all the way here where it says profitability, and profit margin is at the moment for this company 26%. Okay, almost 7%, which is really good. So what we're looking for is about 10 to 20. This company is actually offering us at the moment, well, almost 27%, which is great to see. The next thing we look at is current assets, basically is greater than current liabilities. For that one, we'll go back to financials. Maybe I should have ordered this differently, but yeah, we'll go back to the financials, and we go to balance sheet. Okay, and this place is where you will find how much basically they own current assets, so total assets, by the way, or you can just expand this, and this will give you the current assets. So $29.5 billion, 28.7, 31, and 47. Okay, then you need to look at their liabilities. So current liabilities is this one here. Okay, so current liabilities for this year, 47, that's their current asset, against 24. You can see they've almost got double what they need. Okay, so you don't have to worry about this company going down anytime soon. Okay, so that's perfect. The next thing we're going to look at is the free cash flow. Okay, 4 to 5 years. And this one, you just need to stay in the same place, financials, and go to cash flow here. Scroll all the way down, and you will see at the bottom here, okay, you've got 10 billion, 14 billion, 16, almost a 17 billion, 20, almost a $21 billion. So they have $21 billion in cash. This is basically one of the reasons they can pay their dividend. They can invest in the company. Recently, actually, they announced, and Intel announced that they will be spending $20 billion building a new warehouse or new basically factory in the US so they can produce more chips, because currently, there's a shortage in chips. Okay, so the next thing we need to look at is the number of shares outstanding. Now for this one, you just need to go to balance sheet and then scroll down here where it says shared issued. Now 4.6, 4.7 billion, 4.5, 4.2, and then 4 billion. Now that's really good. So from almost the 4.7 to 4 billion, okay, you can see it's going down. What that means is they're buying back their own shares. Okay, so three things companies do. They innovate and they come up with something new, so they use some of the free cash flow for that reason. Sometimes they buy back their own shares, so there's less out there, which means for you own more of that basically share, okay, but of the company basically. Okay, so your ownership goes up, if you like. Whereas when they actually give you more shares or basically issue more shares, you all of a sudden you've got less than basically what you bought. Okay, so that's one of the things. And the third thing they do is basically use it for dividend. Okay, so that's why some companies, because they've got a lot of excess money, they start basically giving out dividend. And this is basically one of the companies that actually pays, I think they pay about 2% dividend, which is not bad at all. For a technology company, that's really good. Okay, the next thing is the return on equity. We said that has to be 15% or more. According to the books that I've read, everyone kind of more or less agrees, especially this guy is actually kind of agrees that 15% or more is what you're looking for. And for that one, you need to go back to statistics, scroll down here, management and effectiveness. So, and then return on equity here. Okay, so 26.36 is what it is currently for Intel. Okay, so that shows you. So basically this helps us, right, as investors. It measures how management is basically using its assets or resources to generate more income. So based on the current assets that they have, what are they doing basically to generate more income for us? Because that's why we're interested. We want to know if the company is actually making a profit, right? And this is basically one of the ways. And if you can find a company whose return on equity is 15% or more, then that's perfect. Okay, obviously you need to look at the other things as well, but the return of equity trailing basically for this company for the trailing 12 months, okay, is basically 26.36% at the moment. And the final thing I want to mention here is the payout ratio. And the payout ratio basically it's a ratio that you can easily find. I like when it comes to dividends, I go to normally Seeking Alpha. So this is Intel. If you click dividend, okay, and scroll down here, you will see the payout ratio. So this is basically the yield. This is how much they pay per year. The payout ratio is about 30%. Okay, and what we said is about 61%. Basically, according to Simply Safe Dividend, where they use this algorithm, the research and behind and all that stuff, is basically what they're saying is 61% is safe. Okay, is perfect and above. Anything below below 61%. If it's above 61%, you have to be careful. If it's 75%, you might used to be about 75%, but lately I've kind of changed my mind because I think I've seen a few companies that cut their dividend that payout and their payout ratio was about 70 or more. Okay, so this is another thing. So if the company that you're interested pays dividend, then look at the payout ratio and just make sure they've actually got enough cash to cover this by actually going to obviously for their financials and check how much free cash flow they have in their balance sheet before you invest in that company. So if you invest in a company like Intel that has about 21 billion free cash flow sitting around, okay, then you have absolutely nothing to worry about, and you know they are going to cover that dividend. I hope you enjoyed the video. I hope it was useful. This is basically some of the things I do personally. You might have your own. There's billions of other stuff to look at, but this is kind of helps me narrow it down. Then I do a little bit more research. I look at the graphs and so on, and then I study a company. I don't actually buy companies just straight away. I actually do a bit more research. I wait for about couple of weeks, if not a month, just to see what basically how the company performs, learn a bit more about it, do a bit more research. Once I'm comfortable and I like the company, then I start buying some shares of that company. Okay, I'm just being transparent. I'm trying to help everyone out there, inshallah. There's a lot of you that are watching the videos, but you haven't subscribed to the channel or you haven't liked the videos. If you find any values in anything I've done so far, please share, like, let me know what you think. Let me know what of some of the companies that you own. Actually, I really would love to know how many companies you own in your portfolio and what's in there. Mine I've actually been sharing every single day, so I created a video. So I hope you enjoy the video. Thank you very much for watching. Assalamu Alaikum and Ramadan Kareem to all of you.